Hi there, Dan Kurz, DK Analytics. Thanks a lot for tuning in. It is Tuesday evening, April 21st. The title of this video is Twilight Zone Oil Prices. Let me go through some brief valuation metrics and hone in on the oil price situation. The DXY closed today at 100.2, the US dollar value. The Fed's balance sheet, the level, $6.4 trillion. I've gone into that a lot in the past, so I won't belabor it here. The 10-year Treasury yield 0.57%. The S&P 500 closed today at 27.45. Oil was up, I'll get into it, at $10.01 per blue barrel. Gold closed at $1,700 per troy ounce, and silver at $15.07 per troy ounce. Yesterday, oil got creamed by ultra low-cost Saudis looking to finish off U.S. shale oil producers once and for all. Then, May oil delivery contracts collapsed to a surreal negative $40 a barrel as committed takers lack storage capacity. What on God's green earth is going on? Well, the coronavirus cure is what is going on. It continues to be much worse than the disease, as I have continued to assert and have repeatedly asserted and ascertained over the past 6 weeks or even 7 weeks or so. Speaking of which, Stanford immunologist Dr. John Ioannidis, after doing statistically significant morbidity rate survey in California on people infected with the coronavirus, disclosed over the weekend that 0.1% of infected people will, on average, succumb to the coronavirus, making it about as likely as dying if you go for a trip in your car from home to shopping to work, right? The likelihood of an average person dying from the coronavirus, an average infected person dying from the coronavirus, is about as likely as you dying when you get into your car to go someplace. Right? Yale immunologist Katz has reached similar conclusions, as has the former head of immunology at Rockefeller University, a person of German extraction, Knut Witkowski, I guess German-Polish extraction. And these scientists, all three of them, have warned over and over again during the last 6 weeks or so to 8 weeks about the probably counter-constructive policy decisions rendered by authorities that were made related to the coronavirus threat. Yet, our authorities shot and asked questions later. Specifically, over the past 6 to 8 weeks, they have shut down and locked down much of the world as regional hide under your mattress coronavirus mitigation diktats have increasingly been issued by local authorities. Together, this has absolutely pummeled demand, especially in the transportation sector, where oil derivatives-based fuel enables planes to fly and cars to drive. Thus, the price of oil has collapsed thanks to demand for oil hitting a wall. Low-cost producers, led by the Saudis and the Russians, have capitalized on the current demand wall and saturated oil storage facilities to force a huge industry consolidation, boding well for surviving oil suppliers, producers down the road on both the price and the volume fronts, as supply will be materially culled, including U.S. shale producers' 6 to 7 million barrels a day of supply, or roughly the same percentage of daily global oil supply. The absolutely unprecedented bankrupting global virus response-based demand freeze is going to decimate global and local supply across the board, from airplane seats to oil production to restaurant chains to small medical practices to regional hospitals to chip makers to car subassembly manufacturers to dairy farms to pork suppliers. When demand comes back, it will be a seller's market. Translation: look for much higher prices. Now, spike that huge supply shrink, supply destruction, with unprecedented amounts of US and global money printing. And sprinkle on top of all that higher inventory levels that will be sought as a buffer against future supply chain disruptions, from corporations to households, from auto harnesses to toilet paper, and you've got a textbook case of monetary inflation superimposed upon unprecedented post-World War II supply-side destruction. In plain English, sharply reduced economic activity juxtaposed against double-digit growth in the money supply, thanks to massive monetary base bloat being transferred via a stabilizing and even sometimes upwards tilting money multiplier to yield too many dollars chasing too few goods and services. That is, combine unheralded monetary base bloat with stabilizing to upwards tilting money multipliers, and you will get, sure as night follows day, too many dollars, or whatever the currency, chasing too few goods and services. To cite an example here in the US, M1 has surged by 15.1% in less than 2 months to 4.6 trillion. Meanwhile, USM2 has surged by 8% in less than 2 months to 16.7 trillion. Contrast this rapid expansion in the money supply, not just the monetary base, with a collapsing economy looking into a depressionary abyss. Now, if our overlords, our authorities, let us go out to work and to play again, like good little kindergartners, instead of continuing to demand that we avoid the sun and stay hidden under our mattresses, what will the coronavirus likely do? It will likely spread, much as it would have before the lockdowns and quarantines, as we are seeing in select Asian countries that instituted draconian lockdowns that have since been lifted. Why? Because we have suspended the virus's ability to spread among the young and healthy who couldn't go to work or to school, a cohort which would have, had they been allowed to do what they usually do, this cohort would have by now expanded society's herd immunity, which is nature's virus containment wall. This is nature's way of shutting down a virus-based disease, because people that get infected and their immunity ends up trumping the virus, mainly the healthy and the young, those people then produce antibodies to the virus, thus shutting down virus transmission, and thus the rate at which a virus can spread can continue to exist. Question: will the authorities shut down and lock down everything all over again if we get a coronavirus uptick down the road thanks to them opening up segments of the economy? Will this again crush demand and then eviscerate supply even more as businesses file for bankruptcy and even more people are thrown out of work? And will bankrupt governments in such a flare-up situation expand bailouts for business that they have forced to close down anew? And will they expand unemployment benefits for the ranks of tens of millions of newly unemployed, courtesy of the world's leading central banks printing the money with which to finance it all? Such an initiative will, of course, be led by the 800-pound counterfeit currency printing Fed, thereby adding to unprecedented monetary base bloat, while another monkey wrench is thrown into an already eviscerated economy that has hit a demand wall with supply being crushed. How does one spell a perfect monetary inflation storm? And if oil can go to minus $40 a barrel in the futures markets yesterday, thanks to investors or speculators committed to taking possession, delivery of it in a month, but are unable to store it, so they'll pay to get rid of it, and thus the minus $40 oil price per barrel yesterday, what would happen to the price of gold and silver when those investors or speculators that committed to buying gold or silver within a month or two find out that the parties that sold the future gold and silver contracts to them can't deliver the metal, even though this time around the buyers will want the metal instead of more paper promises? If oil can go to minus $40 in the futures markets or May contracts to reflect buyers that can't take delivery and will pay just to get rid of it, where could precious metals prices go if those committed to selling can't deliver the gold and silver they've committed to supply because they don't have it to deliver? Now, I know this is an old and tired paper gold and paper silver story where futures contracts to sell precious metals has long exceeded the available physical inventory by 100 to 1 or more. But if minus $40 oil can happen due to an oversupply of oil, why can't an equally dramatic but opposite reaction occur in precious metals, where there is too little supply of the physical? In plain English, why couldn't gold suddenly vault to $2,000, $3,000, $4,000 per troy ounce or more, or silver to $20, $30, $40 or more per troy ounce, which would turbocharge precious metals demand, as rising prices always does, and in turn trigger even higher equilibrium precious metals prices, because the physical precious metals supply shortage will become even more transparent and even more pronounced. This is what happens when politicians and bureaucrats try to print wealth while they shut down the production of wealth. And, lest I forget, the current drubbing of oil prices will not persist, as supply will cave on a sustained basis given both geology, it's getting harder and harder to extract or more costly, and due to finances. Investors aren't going to finance what should have never been financed again. And all this while oil demand will recover and sync with economic growth. So supply is going to ratchet down and stay down. Oil demand will recover in sync with economic growth. And that is the opportunity for the survivors, right? Needless to say, for those investors with a strategic perspective and a contrarian streak, strong balance sheet, constructive reserve life, publicly held oil and gas companies should be a great buying opportunity. That's it for today. I hope you found this video of interest. Constructive criticism is welcome, as is a thumbs up if I've earned it. I'm going to say over and out. It is Dan Kurz of DK Analytics on Tuesday evening in Bonita Springs, Florida on April 21st, 2020. Thanks for tuning in. Bye-bye.